Hey guys, I'm Derek Wilkins. I'm with my cousin Drew Nichols, and we're back again this week to talk about laddering your equity index annuities. Hey Drew, how's it going?
It's going well, Derek. So when you told me that you wanted to, add the laddering concept to our video sort of menu that we're working on, I got to work, and there's a couple different ways we can use the term laddering when it comes to annuity. So today we're going to dive into a couple of the specifics. What got you thinking about this? Like, what brought this concept into your mind to put on our list?
Great question. I've just been talking with, dozens of clients about lifetime equity index annuities. And for those who are new to our show, we talk about retirement planning in general. We've been on uh, lifetime income using equity index annuities kick really for the past couple years. Before the Fed increased rates, they weren't compelling. Now the Fed's increased rates from 0.5% to 5%. It's made these insurance companies create some very compelling products. So we're doing a lot of these lifetime income annuities. And as we spoke about last week, there's a couple main concerns people have. It's what if I need long-term care? What if my health fails and I need someone to take care of me? I have to go to a nursing home. That's a big concern. The other concern is what if I run out of money? What if my 401k that I've been living off of runs out at age 85? What if I live to be 95, 100? So you can allocate a chunk of money, put it into an annuity, and the insurance company will guarantee you a lifetime income stream for as long as you live. And how laddering plays into that is, say you had $500,000 you wanted to put into an annuity, and you were kind of unsure of when you wanted the income to turn on. So say you're 60 years old and right now you're thinking, I want to turn on income at 65. So as opposed to buying one annuity, you can break it up into two, three, four, even five annuities. So that just gives you the ability to, at age 65, if you felt like you wanted to only turn on two of the five contracts, you could do that. Now, Drew, why would somebody want to delay turning on income? What do they get out of it?
Well, first of all, there's no penalty to doing it this way. So, if you were going to lose something by spreading your eggs over multiple baskets, we wouldn't be recommending this. So, there's no downside other than just slightly more paperwork on the front end, but that's about it. So, there's no downside, there's all upside. The reason why might want to consider this is just the flexibility of maybe you don't need that full income, which could be, at some years, it could be $100,000 a year of income. Maybe you don't need that, but maybe something in your life changes with your income stream. I'll give you an example. My dad had in retirement had an income coming in from a company he'd worked for like 25 years before. And at some point, that pension ran out, and he could have turned on one of his income annuities to supplement that income without having to turn on the whole shebang. Because the beauty of these policies is that they grow a little bit more than 10% per year for the first typically 20 years that you defer in terms of how much they'll pay in income. So if you don't have to turn them all on in one year, you could win that way.
So you're saying if you chose to, say you had five contracts and you chose to turn on two at 65, but if you delayed the other three for, one, two, three, four, even four more years, they're going to bank, a little bit over a 10% increase in income each year. Is that what you're saying?
Exactly. So I've got some numbers here that I'll give you. So for instance, a 63-year-old turning on income at 68 is going to get about 11% return on whatever. So let's say it's $100,000 annuity. It's going to make a little over $11,000 a year in lifetime income. But if he waits 5 more years, we're up to like something like $16,000. So you could kind of, I think, to your laddering point, you could turn on one in year 5, another one in year 7, another one in year 9. Start collecting that lifetime income earlier, and then sort of the cumulative addition of all of them would provide you, that total lifetime income once you're done with the ladder. So it just gives you a lot of flexibility. Now, I think going to 5 contracts might be unnecessary, but definitely 2 or maybe 3 Let's talk about, one of the other things we talked about in the green room, which is, in addition to using multiple contracts, you could use multiple companies.
Yeah, so these equity index annuities, think of the income rider is kind of the safety net. So there's some that give you 8% compound, there's some that give you 10% simple guaranteed for the next 20 years. There's some that give you 9.5% compound, but it stops growing in 10 years. Now, in the back, so that's guaranteed in the contract. So whatever that is, your income base is guaranteed to grow those percentages. Now, in the background, your funds are indexed to common indices such as the Nasdaq, the S&P, Fidelity, BlackRock, Morgan Stanley. There's just a ton of different funds that, in the background, your actual contract value is growing. So the hope is the market continues to grow and the actual annuities value grows quicker than your income base. And if that's the case, you're going to have a much higher income, um, because it then will be based off that higher the higher amount that the markets grew your actual contract value to.
Right. So in the example of going with multiple companies, the way that would play into this is, um, each insurance company has some different indices that they will offer you. They don't all offer the same stuff. Most of these are proprietary indexes that have, like you said, some of the name brand funds have created indexes that the insurance company can buy options on and things like that. Getting a little too technical, but you could, for instance, buy multiple companies' annuities to diversify a little bit from. It's very low risk of a company failing. When we're looking at the companies, we're looking at A+ rated companies. So low risk there, but you could also diversify across different investment options. And really, again, just the classic, don't put all your eggs in one basket. So you could do laddering, you could do spreading across multiple companies. There's not a lot of downside to this because the way these things work, let's talk about bands for a second, because I don't think people realize that there are different bands in terms of how much premium you put into these policies.
Yes, you have what is called a high band and a low band. And this is just a rule of thumb, not with every company, but for the most part, if you put in $75,000 or more in assets, that's going to put you in the high band category. What that means is you have the highest potential of earning interest on your actual annuity. Low band, and that's just essentially they they have caps and on the indexes. The higher in the high band, you'll have a higher caps, which means that if the S&P is say 6% capped on the low band, maybe it's 8% capped on the high band. That's just an example. So the more money you put in above 75,000, you're automatically going to be in that high band category. And just going back to your point on diversifying with companies, we truly don't know which annuity contract or which indice is going to perform better in the next 10 years. Obviously, the past performance of them doesn't predict the future. So it's like not putting all your eggs in one basket as far as stocks, as opposed to buying just Apple stock. Maybe you buy Apple, Nvidia, GE, Southern Company, Home Depot. You buy 4 or 5 companies, and if one company is down, you have the other ones to kind of balance it out. So that's essentially what the thinking is have 2 or 3 annuity contracts, and and you'll get a nice average of the 3. One might be hitting a home run, one might be average, and one might be low, but the average will net you a nice return.
Yeah. And then if you're looking at strictly the guaranteed income numbers, which a lot of people are, there are some companies that will provide you the highest income in years like 1 to 4, and then like 6 to 10. But year 5 might favor a different company. So with this latter option, you could turn on the income from the company that has the sweet spot in that particular year. So I don't want to use any specific company names just because they change all the time. And by the time somebody watches this, they might think, oh, that's such a great deal, but the deal's changed. But let's say company A and company B. So this is a real world example I did for a client. just a couple days ago. So for her, if she went with company A, she would be better off on the income if she turned it on between year 1 and 4 or 10 to 20. But the company B, she would get more income if she turned it on from year 5 to 9. So their sweet spot was in 5 to 9 by quite a bit, several $100s a year in difference. I think it was actually closer to $1,000 a year in difference. I mean, we're talking real money over your lifetime, could be $20,000, $30,000. So she could pick the company that she wanted to turn income on from with this ladder. Now, back to the point you were just making about the high band, low band. The reason why I brought that up is because if you're only playing with $100,000, we want to keep it all at one company so we get that high band. This really applies to an increasingly large part of the market we see where we're going 2, 3, 4, 500,000 and more. I mean, I'm probably doing more 200,000 than I am $100,000 just because that gets such a nice income amount. So that's why I bring it up. Now, I wanted to talk about a slightly different concept, and I'm going to put it on the screen here and share my screen. And so we'll try to hook it all up so our viewers can see this. There's another way you can use laddering with annuities, and that involves using the 1 year and 2 year point-to-point indexing. So while I get this visual aid ready, can you tell us about the difference between a 1 year point-to-point and a 2 year point-to-point, and how those have different participation rates?
Right. So what those are is the policy anniversary date of your annuity. Say it's going to be September 1st, 2025, and you attach it to the NASDAQ. The company is going to look at the NASDAQ 100 index or whatever index that you choose and say it's 100. They're going on a 1 year point to point. They're going to look at the index exactly 1 year later. So it'd be September 1st, 2026. Whatever percentage up it was, hopefully up, times your participation rate, which a common one might be 75%. You're getting 75% of the NASDAQ would be your return. So if it was up 10%, 75% of 10% would be 7.5%. So that would have been your return on the 1 year. Now, on the 2 year, they're going to look at it from September 1st, 2025 to September 1st, 2027, 2 years later. And they'll give you a higher participation rate. And a common one might be 125%. So if it's up 10% over that 2 year period, you're going to get 12.5% over that 2 year period. So it's very common where we'll do a little bit in each. So maybe you're doing 50% in the 1 year point to point and then 50% in the 2 year point to point, just to kind of give it a nice average, because we truly don't know. It's going to be based on the timing of the market, if the market's up or down when your interest is credited. So again, another diversification tool.
Right. So the biggest point that I just took away from everything you said is that the 2 year point to point will provide you a little bit more oomph than the 1 year point to point. And that makes intuitive sense, because if you think about it, the companies, they're doing all this using typically options bought monthly or quarterly and that kind of thing. So they can buy those 2 year options more affordably and manage them in bulk and in an easier fashion than they can. So they can get ahead and then provide some of that gain trickle down to you as the policyholder with a higher participation rate. So
exactly.
We want to get 2 year point to point participation rates, but if we put all of the money into a 2 year point to point, what happens is every other year, your annuity is not growing at all. And in fact, if there's any small fee related to the indexes you're in, you might actually be taking a click back in terms of what's on the annuity. So let me introduce the other laddering strategy, where you can use 2 buckets of money inside of your annuity. This is going to get a little technical, but just hang with me here, to get 2 year point to point indexes on all of your money, but still have growth every single year. So I'm going to bring in visual aids here. So what you do is you put half of your money when you first buy the annuity. I'm going to use a $500,000 example here. So we're going to put half of our money into the 1 year strategy. So the first year, we're going to use 1 year point to point on half and 2 year point to point on the other half. Now, when we get to the 1 year policy anniversary, So 1 year into the annuity, so this is going to require a little bit of planning with your agent, and it's something we talk to our clients every year typically. At the 1 year anniversary, we're going to reposition. We're going to take whatever gains, if any, came in on the 1 year point to point, move those into a 2 year bucket. So let me show you a slightly different way of looking at this. Let's go to this. Okay, so we've got our 1 year strategy for 1 year. And then we put the rest in a 2 year strategy for the entire 10 year annuity. So every other year, it's going to be getting its gains. Then after 1 year, we move the 1 year money into a three from year 1 to 10 into another point to point. So what you're going to see is every other year, one of the strategies is going to hit on its point to point. Does that make sense, Darrick?
Yeah, no, that's
I think
actually
it's pretty clever. I mean,
pretty
is
clever.
this going
Yeah.
to be the best way to do it? We can't guarantee that, but it's a nice way to get that upside of the point to point, 2 year point to point with a higher participation rate, and still have gains every single year clicking in.
Great. Well, we just wanted to hop on today and kind of go over this laddering strategy. And, we're LTC Tree, we're a retirement planning specialist, and we've been doing this for over 25 years. And we work for you, not one company. So when we go shop the market, we're going to shop every single equity indexed annuity out there, fixed annuity out there, and find at the time that you're considering doing this, what company out there is giving you the highest guaranteed interest rates and the best shot at growth. So if you'd like to learn more, you want to talk with us, Drew, how can they get in touch with us?
Yeah. So to see if you qualify for any of these options, because there are some different financial qualifications, even some health qualifications in some situations, just a quick phone call is always easy, or fill out the form on our website, and we'll start working in the background on getting you some illustrations. So we're ltctree.com, and I'll put our phone number down in the show notes, and we'll maybe put it on the Chiron here on the video. But yeah, Darrick and I, we're not a two-man shop. We have other agents that work with us inside of our team, and we'd be happy to just brainstorm. I mean, it's gotten to the point now where we get calls from people who've seen us on YouTube all the time. It's kind of fun, and we'll just talk about what's going on with your situation and see if there's anything that makes sense, and spitball ideas. We're happy to do it.
All right. Thanks for watching, guys. We'll see you next week.
All right. See you, Darrick.